Hi, I'm Vishwa. In our previous videos, we have talked about trading strategies and concepts. We saw how you can reduce your technical risk on your trades by using these strategies. Now, in this video, once again, we're going to talk about reducing your risk. But this time, we won't be using any form of technical analysis. Instead, we're going to use a money management trick with which you can reduce your risk even before you buy a stock. Normally, when we hear the term money management, we tend to casually ignore it. Instead, we place much more focus on achieving a high amount of accuracy on our trades. While it is nice to have a good accuracy on your trades, it is not the only thing that helps you succeed in your trading. You can practically have a strategy that works only 50% of the times and still be profitable. In this video, we will talk about one such way to effectively reduce your trade risk. At the end of this video, I have something for you. So watch the video fully and get the full benefits. So let's get started. What is money management? Well, basically, money management is taking charge of your capital, controlling how your money should work for you, so that you can make profits consistently on your investments, while at the same time reducing your potential risk. Now, there are a lot of creative ways in which you can use this money management, depending on the size of your capital. But in this video, we're going to talk about one of the most simple and commonly used technique which you can use even if you have a small capital. Now, most of you would have already heard the term the 2% rule. What it says is this: do not risk more than 2% of your capital on a single trade. Well, that sounds pretty blunt and very insignificant to follow, and most of us ignore this rule just because it is this simple. But the true magic of the simple math is only revealed when you actually put this into your trading. So let's go on and check some of the stocks to clearly understand how this 2% rule gets the job done. Here I have some 5 stocks from this week's positional trades. And I picked these stocks based on simple candle patterns, which you might already know very well. So, in this stock, we have a bullish piercing line pattern at a strong support. And here we have a bull sash pattern at a strong support level. And in this example, we see a morning star pattern at a psychological support level. And in here, we see a bull sash pattern again at this consolidation support. And lastly, we have yet another bull sash at this strong support area. So, in all of these trades, we follow the same simple rule: bullish candle patterns at strong support levels. We're not going to look for anything else technically. Rather, we're going to use money management to control the amount of risk we are taking on every trade. Now, this table clearly tells us how our risk looks like with or without applying the 2% rule. To keep things clear, let us assume that I have a capital of 30,000. And from our 2% rule, we can only risk 600 rupees on every trade we take, which is 2% of our initial capital, 30,000. And as you can see here, these are the total number of shares that I can buy with the 30,000. But if I just go on and buy these stocks in these quantities, my entire capital will be at risk on a single trade. Also, the risk I will be taking will completely vary for these trades like you see here. But instead, what I will do is I will limit the number of shares that I buy so that my risk will not exceed 2% of my capital. So, applying the money management, these are the maximum number of shares that I can buy to contain the risk. Now, as you can see, you can trade any of these stocks, but the risk that you will take will all be the same. It won't exceed 2% of your capital, in this case 600. And one advantage of using this 2% rule is that even if I lose on 10 trades continuously in a row, I will not lose more than 20% of my capital. So, by this way, I can actually effectively control the risk in trading when things don't work out in my favor. And another interesting advantage when employing this money management rule is that you can have an average amount of accuracy and still make consistent profits. Now, in this table, I have input the entry, stop loss, and targets for these trades. And for target, I have used the standard 1:2 risk-reward format. Here, to clearly understand the concept, let's just imagine that I have taken all these 5 trades. And out of these 5 trades, I have only made profits in 2 of them. And the other 3 ended in a loss. And that gives me only about 40% of accuracy on these trades. But still, I managed to come out with profits of 600. So, in this whole scenario, even with a very basic analysis that only works for about 40% of times, I still made profits in my trades, just by applying this 2% money management rule along with the 1:2 risk-reward ratio. Now, you won't be getting this result if you do not apply this 2% money management rule and trade with a random risk. Your rewards will be skewed as your risk profile is not defined. So, I think now you have a clear understanding of how important the money management is in your trading. So, I thought this topic would be really interesting to you guys because it just drills down on reducing and controlling your risk with iron hands. And as I mentioned in the beginning of this video, if you're interested in our Excel sheet calculator for number of shares to buy with this 2% rule, you can find a link to it in our Candletricks Telegram channel. So, I hope you really enjoyed this video. Thanks a lot for watching. Have a great day. Thanks.